Hello and welcome to BGA Coffee Talk. This is our weekly session that we provide industry insights, information, policy updates to the agents to help them better find the sales they need to grow their business. Now, we're doing this format a little differently from here on out. We're going to be filming these and then coming back at the end to record this intro and give you information on where you can find specific pieces of this. You'll also see all the information segmented out on the bottom if you're on YouTube. And if you're on past podcast platforms like Apple or Spotify, you'll see it in the show notes. So today we're going to be talking with Bill Whitsell, Senior Vice President at National Life, and Executive Chief Underwriter and Head of Business Acquisition. So we're talking to him about what makes National Life Group unique in their mutual company format and how they're competitive still with pricing. We're diving into accelerated underwriting and their reflective underwriting engine as well, seeing what the difference big data and artificial intelligence make on underwriting and mortality, how his view on mortality has changed based on the pandemic, as well as industry practices that are beneficial and ones that might be unsustainable, and the niches that National Life play in and the hopes he has for the future of the industry. It's a great episode. It's a dynamic conversation, as all our conversations are with National Life, and I hope you enjoy. All right. Well, Bill, thanks for joining us today.
Yes, thanks for asking me, Trent. It was good seeing you a few weeks ago in California.
Yeah,
So, yeah, it was good.
it was, and that was it was a brutally honest conversation we were having.
Yeah,
So I'm hoping we can get more of that today.
I'll try. Let's see what I can do. So,
Well, Bill, let's take it from the top because I want to know some of your background. How did you get into insurance and underwriting?
that's a great question. So, like many people coming out of college, I was on the streets looking for my first job. I was looking for something actually in advertising or marketing that was aligned to my studies. So, I actually got an interview with a health and a life company thinking I was going to be in the marketing department. So I get a call. Congratulations, Bill. We would like to offer you a job as an underwriter trainee. So the first thing I said was, okay, I'll take it. When do I start? And then the second thing I asked was, what does an underwriter do? Because I absolutely had no idea what an underwriter did. So, so really, fate led me into underwriting. And as a side note, my dad growing up was a general agent. And when he
Oh.
heard, and when he heard I became an underwriter, he actually thought I betrayed him. So it's always been a joke up until his passing about me going into underwriting.
I get that. There's always the battles going down between us, but also
That's
friendships
right.
that emerge from it.
That's right. So I yeah, by fate, here I am.
Did you ever underwrite any of your dad's cases?
No,
Uh,
they wouldn't allow me to do that.
uh,
So no, absolutely. We worked at separate companies. So
gotcha. Well, you're now with National Life Group, and how long have you been with them?
I'm actually in my 15th year, just got to be wrapping that up. So 15 years.
So I can't say now you're with National Life Group. You've been with National Life Group,
Oh
uh,
yes.
but you're executive chief underwriter there, and I want to
Mhm.
know, coming into that, what was your goal running that underwriting department?
Sure. I'd been working for several direct companies as well as a reinsurer already in my career. And I had been connected to some industry groups through my career before National Life, where we always talked about mortality trends and dreamy approaches of the future of how we could expedite underwriting and new methodologies. Questions we would always kick around was, hey, do we really always need to order the same medical requirements on a 30-year-old that we do a 65-year-old? These were theoretical discussions back before I joined National Life. Back in those days, everybody got an exam and a blood profile, et cetera. So I had actually pitched to the company I was working with at the time a plan to eliminate certain requirements on younger applicants and face amounts. And at that point, I was told, hey, that's never going to work. We're going to erode mortality too much. So at that point, I decided I needed to leave that company and find a new company aligned with my vision. So When I went to National Life Group at the time, that was a small company in Vermont. I think we were a top 60 company at that time. And I met Mayron, and I told him I really wanted to help change our industry. And I think he had definitely the same idea, and the rest is history. But at that time, National Life Group was into very traditional underwriting. They did exams, blood profiles, even chest X-rays on many of their applicants. They got almost on every case in APS. So my goal walking into that company was to take the vision I had and improve cycle times, streamline requirements on cases, and hopefully reduce cost and maintain good mortality results. So those were my goals when I joined National Life Group.
And so 15 years in now, how would you rate your progress with these goals?
That's a good question. I think we've done well, um, not perfect. I don't think we've done everything perfect. We've definitely moved the needle for National Life Group. Today we're a top eight insurance company as opposed to 15 years ago when I started. And I think our underwriting approaches, along with the product, our sales and marketing teams helped get us to the position we are today. Our middle market business has really benefited from the non-fluid underwriting and engine approaches we utilize on this segment that traditionally is less than 500,000 face and usually is under age 50.
Well, your top eight, and you guys have seen explosive growth in the last few years. But you're still a mutual company, and I think that's unique. And we talked to Mayron a little bit about this of just being a competitive uh, provider while being mutual. So talk me through your side of that and what you see, how being mutual helps this and how you stay competitive.
Well, that's a great question. As mutual policy holders are actually the owners of the company. So, in essence, we serve our owners by making sure our decisions are beneficial to them. So that really is the difference because publicly traded companies, usually the shareholders are the ones that are best served in those organizations or ultimately served in those organizations. Shareholders tend to be interested in returns they're seeing from investments. And sometimes that just doesn't align
Hmm.
with policyholders. You know, if you recall, there's been companies, pretty large companies, have been forced to sell parts of their company or get out of certain segments of their business because their shareholders didn't feel it actually met returns and their expectations of returns. And some of those companies actually exited the individual life business because they didn't think the margins were there, and that's the shareholders. Since we're a mutual company, our policyholders are first of mind when we take a look at things like caps, interest rates, line of business, et cetera. We want to return value to them rather than outside interests. So the other point I wanted to make is also with the mutual company, you usually see competitive in-force crediting rates. If caps drop, they usually are reflecting the market. There's not another reason. Or your policy is staying with the company that sold it to you because mutual companies have policy provisions that are designed to keep you a customer for life.
Hmm.
Some public companies just take the opposite approach because in some cases it can drive more value to the stock owners. But I believe there is a sense of safety if you have a policy with the mutual company, especially today.
So on our side, when we're running quotes for several different IUL carriers, not often are we seeing the mutual companies be in that competitive pricing band. I think there's a lot of benefit, as you're saying, to being mutual and safety in that. But how is it that National Life Group is able to compete with the publicly traded companies, but also offer all the benefits of being mutual?
Right. Well, I think we've found a niche, and Mehran has coined this, and I actually have also I use it a lot. I steal it from him. We actually refer to ourselves as a progressive mutual.
Hmm.
Okay. And I think what that means is that we're going to take advantage of our mutual structure, use it to help us grow, innovate, and spread our vision of bringing peace of mind to everyone we touch. And this approach really starts with the vision of Mehran and the board. So many of us, including myself, the actuarial teams, the sales teams, all of my underwriting teams have worked for publicly traded companies before, and we realize the advantage we have in the market as a mutual company is really strong. And so becoming a progressive mutual and being very, we're all very competitive, and we feel that we can design products and process innovation in the safety of a mutual company so that we can ultimately gain market share and compete with anybody that's out there. So I think that's really why it's all working for us.
Well, you said that everyone's very competitive, and I've seen that with you
Yeah, yeah, yeah.
guys. So, your company also is a leader in living benefit riders.
Right.
How often are you seeing insureds opt into these?
Yeah, that's a great question. So just for a review, our products are designed to pay benefits if you die too soon, which is really the death benefit, live too long, which is an income stream for life, or if you become ill, and that's the ABRs, that's the living benefit riders. So we can actually illustrate solves for all three of those ways you may want to sell our product, and gives options to agents, and they can lead with either one, any of those at the point of sale. But all ABR riders are actually included as part of the sale. Now, that is only if they're approved in the states that you're writing business for us. There's some of the writers we have that aren't all approved. The writers that we actually consider living benefits writers are the critical illness, chronic illness, terminal illness, critical injury, Alzheimer's disease, and fertility journey writers. So we have 6 of them now, and so sometimes they're hard to remember. But the only time that we would not include ABR riders would be during the underwriting process. If we discover a pre-existing condition that could actually land a client into a claim situation right after the product's issued or something like that, we may remove them. We would remove only the ones that we would be concerned about. Or also in the guarantee issue within our executive bonus plans, since we have guarantee issue in those, we'll knock off all the ABRs and only give a terminal rider in those cases. So it's really, to answer your question, it's about individual underwriting, but also we could knock them off in a guarantee issue situation.
Well, I know I'm going off script a little here, but with all these just built into the products, uh, I'm sure that adds a lot more complexity into how you are building and pricing out products that, like we were saying, are competitive still, but have a lot more flexibility and options to them.
Oh yes, it brings a lot of complexity. So if you think about, again, going back to the basics of our industry, the Society of Actuaries has actually said that anytime you touch the death benefit, it's considered a mortality event. Well, obviously, living benefits touch the death benefit. You still may be alive. It just accelerates them. So that actually complicates also experience and how you look at your experience and how you navigate your actual mortality. And so that in itself can also complicate the way we look at things. But yes, our folks that actually take calls in the CEC or in policy administration, they have to know a lot of things, right? They have
Yeah.
to know quite a few things, and our claims departments do too. So it has complicated things, but we have good people that can navigate those waters, and we've actually figured it out.
And is there anything, I know we're going back playing this mutual company card a lot, but is there anything in being mutual that helps you build these products in such a unique way and underwrite them well?
I think um, today most of the high value underwriting approaches are the same between a public and a mutual company. We're all competing for market share, and there's we overlap quite a bit. There are some subtle differences, and see if I can highlight those for you. If you understand that a mutual company is focused on the policyholder, the underwriting mindset, that we have is really in the mutual company as a customer for life. So we underwrite conditions not as much on a lapse supported basis. We actually underwrite them that we're going to have this customer, longer than normal. So, an example of that is we design our term with full convertibility privileges. When your term is up, you can pivot to any of our permanent products. Most stock companies are a little bit more restrictive, or they expect the applicant to move the policy every few years by choice. Um, you know, if a company is actually, changing crediting rates, that also comes into, our thinking process when it comes to underwriting too. Will we continue? We usually continue our crediting rates where you may see those vary a little bit more on a public um, company level. I also see deeper commitments on the mutual company side to R&D efforts and underwriting. You know, that may have to do with mortality results from older blocks or longevity in the industry. National Life, we have a dedicated research and development team that's actually sits within underwriting, and it does analysis that makes changes to underwriting tools or brings new ones to the table. Um, Sometimes stock companies can't afford to do that, or they have external types of options that bring that into them. Um, so those are probably some of the subtle differences, Trent, if it makes sense to you.
And I'm glad you brought up the R&D side. I mean, we're seeing a lot of changes happening with underwriting now. What are you predicting out of the next 5 years?
Change. I think I'm predicting change in the next 5 years. The biggest driver of the change, I still believe, is consumer preferences. Today you can go online, you can get immediate gratifications from companies like Amazon. You can buy and finance a car or a home online. So consumers have really been conditioned to expect certain types of service and gratification. you know, Life insurance agents don't want to give their clients a lot of time to change their minds either. So this kind of fits in there, or lose interest in the sale, especially with a lot of different opportunities out there they may be able to find elsewhere. So I think that is the biggest driver, is the consumer instant gratification and agents realizing that things move a little faster. So I actually think you're going to see a lot more electronic APSs that are going to be screened and key items pulled out for the underwriter that will save time. In fact, as these continue to move mainstream and are delivered and analyzed within seconds, you may actually start to see them be used more than prescription data or medical claims data in the marketplace. The technology is moving really quickly, and APS is the gold standard. It gives you everything the doctor is talking about, and to get those in instantaneously and analyzed is going to be a real game changer. So that's going to be probably a good area of change. Um, Also, I think that's going to lead to what we call smart ordering of requirements. So if you can grab more APSs instantaneously, analyze them in seconds, you're basically throwing away the constraints of age and face amounts for exams and blood profiles, because those requirements in the future could become contingent on what's not in the medical records.
Hmm.
So, you know, you could actually find somebody, as an example, that wants $5 or $6 million of coverage and could be age 60 or 62, and you have a complete APS, you have testing, you have everything you need. Why go back out and bother them? Go ahead and make the decision. So I think those things are going to move things, a little quicker. I also think there's going to be more investment in positive outcomes on administrative tasks that will make the process go faster. I think you're going to start seeing letters and communication quickly created by potentially AI tools that are very interactive and detailed. I think you can also, when people do get blood profiles for insurance, expect more screening tools that actually test the applicant for cancers that they may have now in their blood. And I think those are developing really quickly. So you can actually, if it could be a new finding on exam, and those will be coming to the surface. Um, there's also something really interesting, Trent, and I've seen these tools. There's futuristic tools that have been developed that are non-invasive, and they can actually scan your body and face and tell you what your pulse rate is, your BP, your weight, A1C levels. It's kind of like Star Trek, so
Really?
it's really interesting, and those things are developing rapidly. And then the last thing, I would want to mention. I'm sorry, I have a long answer on this.
Please, this is great.
I think behavioral analytics is definitely arriving, and what that is the study of how clients answer medical questions and what how they omit information, and being able to analyze the way that they do answer. And I think what that's gonna lead to is during the application process, I think behavioral analytics is going to start to identify people that aren't telling you the truth, and it may send a message to the agent that, hey, you may want to re-question them. I don't think this person's truthful. I doubt it's going to get through the process. So I think that will be a benefit, could be a time saver for both the company and the agent. So those are things off the top
Yeah.
of my head. And again, it's just my opinion and from what I'm seeing and what we're talking about.
How does that behavioral analytics work? Is it comparing their answers to data we already know about them, or what?
Yeah, it's that, and it's patterns in the way they're answering certain questions that are related. So yes, and it comes to conclusions, and yes, it definitely does pull data as you're answering the question, analyzing your answers, tracking it back to other questions that may be related, and it gives a very quick profile of if is this person, is what they're telling us, does it hold together, does it make sense, are there gaps in it?
Yeah. And now, National Life was also a leader in reflective underwriting engines well before COVID. So, doing real-time script checks as someone was completing the app. Um, but with a lot of the stuff you're saying and the growth that's happening, how much of that can be built in real time?
Um, yeah, I guess that's our first engine came in 2011. Okay, we were actually one of the first companies to use an underwriting engine to solution cases. We moved to our second generation underwriting engine in 2016, and right at the time we put that engine in, the pandemic hit. Okay, Um, and just as a postscript, I give you a little bit more information here. That engine was originally designed to do face amounts up to 2 million and had graded approvals up to age 65. And when the pandemic started and people started working remotely, we quickly added the ability to deliver policies electronically, as well as take applications via GoToMeetings or Zooms on a non-face-to-face basis. So you had absolutely a front-to-back non-contact way to sell our products. That actually gave us a lot of momentum. We had strong sales years during the pandemic. And lastly, we also increased our easy underwriting face amounts during the pandemic up to $3 million. So we had some confidence, that this new engine had some really good capabilities. But our engine evolved during the application taking process. We were running background information right after the authorization was taken. And that actually included, we would we're running right now MIB instantaneously, a lot of our databases. And by the end of the application, and we learned this during the pandemic, our IGO process will take your clients back to questions that we've detected that they may not have answered correctly because the data is inconsistent. So the applicant gets another chance, right, to get it right. And maybe they forgot something or what have you. So sometimes when you see that happen, that is, a list of questions we're going back and we're re-questioning them electronically. We want to continue our role as innovators. We think that's pretty innovative. We use medical and non-medical information in our second generation engine to make decisions. We actually moved away, Trent, from black boxes. We don't use LexisNexis any longer. LexisNexis is that box everybody went into and they got scored, and you didn't know why you were getting scored, if it was financial information or if it was something where, in terms of income and job or whatever, nobody really knew what was in that. So we got away with that. Everything today can be shared with the client. It's all medically based. And that's another advancement we've made as we've moved the engine along. And just as a side note, today 35% of our applicants and applications that are eligible for easy underwriting are decisioned without an underwriter getting involved. That also includes those ABRs that we
Right.
were just talking about.
Yeah.
So we really, again, it's a long story to answer your question, but I had to kind of draw that out in terms of the advancements. And the behavioral analytics, we're going to probably add that to the pile we just talked about, and move that even more comprehensively.
Well, the next question I have, I want to couch differently in light of what you're saying. Um, I've heard offline, and I won't name who, just in case they don't want me shared uh,
Sure.
the amount of data they have access to. But was hearing that like you have two guys, both 35, and one of them has diabetes, and you would rate that guy worse. But meanwhile, you're seeing that guy go shop at Whole Foods, has a gym membership, competing in marathons, exercising, doesn't have a TV package, doesn't have a video game console, and has a family. So there's stuff that he wants to protect, uh, and he has a lifestyle that would say he would live longer. And on the flip side, you have a guy who, from his data, he's getting beer, he's getting the sports package, he's staying at home, he's getting uh, takeout every single night, and he has no family and no gym membership, nothing like that that would make him live longer. But yet he would be rated better just for the fact of at this point in their lives, they're not those differences aren't showing. Um, but you can't rate them on all that external stuff that you're seeing in their life. So we're seeing a lot of big data changing this, and you've alluded to some of that, but in what ways is it changing the industry, and is what ways are you unable to use that data as well?
Okay, that's a really good question. You know, I have to start by answering this question to let you know that, big data is a concern for regulators. It's a concern for everybody, exactly where are you getting this data and is it correct, and all those things. So it's obviously a hot item out there. Um, but we don't go that deep, and I think companies can go at different depths on this and have different comfort zones. Um, you know, what we're seeing big data helping us with is specialty sales,
Hmm.
such as COLI or executive bonus. Okay. So basically using a few sets of things that we could actually determine if we're going to guarantee issue something or if we're going to do a simplified issue. And a lot of times things that come into play there, are you actively working? Have you been to a doctor recently? Do you, just a bunch of different things that you had also mentioned come into that to make that decision. Um, Also, when I look at my books of business, I can actually point out high level data points, this big data. I can analyze my block, even though there's not a lot of lives, but I can tell you right now that um, what I see that equates to longevity is, are you actively working? Do you see a regular MD for your regular visits? Are you working out?
Mhm.
Right? Or maybe are you in a dedicated, relationship, and have somebody there that can check your back in case you get a spot on your backs, things like that. So those
Yeah.
are those are those are high level common sense things that we use. Now, obviously, if you're a direct mailing company, or if you're another type of an industry, you can dive deeper. But usually those things they dive deep on don't have the consequences as it would when it comes to underwriting. So we keep ours pretty much at a high level. Um, I think as we continue to build more lives and experience, more data is going to surface. And I think what's going to happen at some point is that insurers will be able to build predictive boxes and drive people with characteristics like that into an even easier underwriting process.
Hmm.
And that's probably going to be the basis of a third generation underwriting engine. And these would be things that are non-controversial, really. What equates to better mortality, and what are these top level things, and let's find those people and move them along the process because that they're going to have a longer lifespan in general. Um, but from a reinsurance standpoint, they have much more data than direct writers do. So they are utilizing big data already to help set reinsurance rates, and which is really interesting. And I would expect them to eventually marry this analysis with artificial intelligence and do a more finite job in reviewing experience and eventually pricing segments of their business more deliberately. And I think by combining those things, some segments may improve in pricing, while others may get worse. And this could eventually translate into rates that get charged to direct writers for reinsurance. So I hopefully you understood
Yeah.
kind of how I walked you through that. I think there's different degrees of that and how we're using it.
And you did mention AI, and I
Hmm.
want to get into that. Are you starting to see it affect underwriting at all yet? And if so, where?
Yeah, no, it's another logical question. We're not really seeing an impact yet, but it is starting to show up, as I mentioned, in how reinsurers interpret their mortality and will charge potentially for their services. And there actually could be winners or losers in the direct company segments that utilize reinsurance. So I think that's where we're seeing it starting to show up. Um, and just to remind your audience, reinsurance costs are actually embedded in the expense segment of policy pricing. So when you look at expenses, in there's a lot of things, and one of those things is reinsurance costs if you use reinsurers. So that could actually maybe drive prices up down the road for certain companies or certain types of situations. That's just speculation. But the other impact of AI right now, that I definitely want to, make sure everybody understands that the impact right now of AI right now is the overall health of your insureds that you're writing. Today, AI is being used to interpret imaging used in cancer detection, cardiac impairments. It can detect very subtle changes that the human eye cannot detect. It's also helping with multiple drug interactions in treating patients. Does this drug match up with this one? Um, Drug manufacturers are utilizing it in studies and developing new drugs and going into different directions. So the first result, in my opinion, we're going to see from AI is going to be the improvement in mortality. I
Hmm.
think this is going to benefit people's lives positively. And again, good health translates into cost of insurance. So that could be something that potentially affects the affordability and lower prices of insurance at some point.
So you just touched on a hopeful note there of mortality with AI.
Yeah.
But also we just lived through a pandemic that m might have also changed your view on it. So, how's your view on mortality ratings changed? I mean, even in just the past 5 years, a lot has happened to affect that.
Are you talking like the mortality experience, right, Trent?
Yeah.
Yeah. Okay. Yeah. You know, it really depends. Post-pandemic, it really depends. What has not changed for me in mortality experience is that we knew that there would be post-pandemic mortality tails. Okay. We anticipated there would be a residual mortality tail after the pandemic. There was no way to quantify it or predict the length of the tail, but we are seeing some change and the emergence of credible trends in reinsurance that could eventually impact pricing.
Okay.
you want me to? I mean, I can go into,
Yeah,
how it's changed if you want me to. Um,
please.
sure. Okay. Um, I don't want to lead. I don't want to lead your questions. So,
Oh,
um,
I love it.
so we're actually seeing evidence right now of the effects of long COVID. Okay. So these are COVID symptoms that persist for weeks, months, or years and can actually create end organ damage and lead to death, sometimes months and years after the initial infection. So that's what long COVID is. So we're also seeing sensitivities to vaccines in some people. Some of these people have complications that are long sustaining that can lead to cerebrovascular or cardiac related deaths. Um, People are still not returning to preventative medical checkups as they did before the pandemic. This is actually mostly occurring, Trent, believe it or not, in our genders, in men.
Yeah.
They're not returning like they did pre-pandemic. And the outcome of these factors, along with the few others I'm going to mention in a few seconds here, um, actually is showing up as a problem in the age 25 to 49 age segments in our population right now. They have not recovered. Okay, they're still lagging a little bit in terms of life expectancy. And again, like I said, we're seeing this more in males, a little bit in females. Um, the other thing that I wanted to mention is what's also contributing is that there tends to be more suicides in this group right now,
Mm.
drug overdoses and violent deaths, which is motor vehicle accidents or death by gun. Um, there may be an indirect connection, you know, of these deaths to the pandemic, such as depression, but it's very inconclusive at this point. Um, and I do want to let you know that reinsurers are actually seeing the brunt of these mortality tales. At National Life, we're seeing some, but not at all to the degree of the reinsurers. And the reason reinsurers see it is they are working with every company. They have a lot older blocks of business. They may assume blocks of business, so they get a much bigger share of the pie, and so it shows up a little bit differently for them. And also here at National Life, believe it or not, Trent, our average age of insured is age 37, okay, which
Wow.
is relatively on the young side. So we're
Yeah.
somewhat protected from the older age and comorbidity deaths.
Right.
So the trends are emerging. We're paying attention to them, and I'm really hoping the tail eventually does run out soon. So hopefully, that answers the questions for you on
Yeah.
that.
And that's surprising to me because I had some long COVID issues and have immediately gone to the doctor and have been doing a lot more preventive work. And I feel like with you talking about depression, that therapy has been much more prevalent in the
Yep.
zeitgeist and conversation. So it's interesting to hear the data is
Yep.
contrary to that, and especially my demographic. Um,
Yeah. It's still evolving.
yeah,
Again, usually mortality trends show up in longer segments,
right.
5 to 7 year segments, but we're all talking about it and watching it.
Yeah. Well, you've touched on reinsurance a lot in this conversation, and a big push of yours has been to be the go-to company for National Acqu Group for reinsurance and capacity. So, what's your strategy with industry capacity?
Yeah. So I have a little different strategy, and I think it may have come from my years working in reinsurance, but our strategy has always been to keep a low company retention. Okay. Um, there's a lot of reasons for that. The number one reason is if you're a growing company and you're growing double digits every year, you want to use your capital, in the offense of your business. So you don't want to put it into reserve. So that's always and park that money and not use it. So that's one reason we do it. But when it comes to actually underwriting and business, I keep a low retention so that I can negotiate very well additional capacity with our reinsurers. So as an example, today we can put together capacity on a single life over $100 million if there's nothing currently in force or they're replacing their existing coverage, which is pretty good in today's market to be able to do that.
Yeah.
Um, we only keep 2 to 4 million per life, depending upon the product, and we have um, we have placed over the past years several $100 million cases and have also several other $100 million cases pending. So we're getting a lot of those looks because we can go get that capacity. Because our company retention is both small and easy to identify, our reinsurers are definitely more comfortable extending maximum capacity they have to us. Also, it does not hurt that we are one of the, if not the fastest growing life insurance company over the past 15 years. So all the reinsurers definitely want to be part of that.
Okay.
So
So why then is National Life the go-to for a big jumbo case, like $100 million case like that? I know you said you can grab more, but walk us through that.
yeah, so um, I think you can best understand that if I can walk you through how, we can grab capacity. Does that
Yeah,
make sense, Trent? Okay,
yeah,
I'll do that. Okay, so keep in mind, you know, probably one of the most, if not the most precious resource in our industry right now is capacity. And the reason's really simple. There are fewer reinsurers and retrocessionaires. Retrocessionaires actually sit behind reinsurance companies, and reinsurance companies break it into smaller buckets for the line of reinsurers that stand behind the initial reinsurers, believe it or not. So those companies and the direct reinsurers, there's far less of them that there was 20 years ago. When I started in the market, I was part of cases we aggregated that were over 200 million, on that we could go to reinsurers today. Um, we probably grab the most or close to the most of anybody in the market, and that's about 105 to 110 million.
wow.
So, because of the capacity issue in the marketplace, if you're an agent and you're stacking coverage, meaning, you're looking at multiple companies to put together what you're looking for, my experience both on the direct side and the reinsurance side is to go to the company that can get the most reinsurance capacity first. And if you start with one company that can get a lot, they can go grab most of the market capacity. There's not a lot of other applications out there. Reinsurers are not concerned that they're over retained and may pull back, parsing their capacity, not giving you as much as you want, because reinsurers don't want to be over retained. They don't want to have more on the books than they can afford to pay. So that's why having a reinsurer, or excuse me, having a direct company that keeps less and can actually grab more is really beneficial to you if you're an agent to start with. So let's say you're writing a $200 million case and you come to us. Let's say we go to the market, we grab you 110 million. Now, what you really have to do is you find the companies that have the higher retentions themselves. If you need to make 90 million up with direct capacity, that's probably three other companies.
Right.
And voila, you're to $200 million and you're grabbing everything you probably can in the marketplace.
Yeah.
Um, and so, the other thing, I wanted to mention to you, we're a company with 50 million auto with our reinsurers. That means we can make decisions on behalf of them up to $50 million. We also have a 30 million auto on our foreign national business. And also they've given us an auto up to 10 million on professional athlete programs. So that translates into some of these other things we can do, having that small company capacity and being able to work with the reinsurers. We can definitely get you some juice when it comes to some of those face amounts.
Yeah. I know after we sat down with you, there was a guy in here who ran into his office because a professional athlete wanted a lot in term since he's not going to be in the US for a while, but now they're trying to convince him, why not just park the money?
Yeah, get some
Yeah,
permanent coverage there. Don't worry about your insurability down the road, right?
right.
So, yeah.
So let's see. Uh, what are some major industry headwinds you see coming up? with expenses, mortality, what have you.
Yeah. Yeah, I mentioned expenses and mortality, I think, when I saw you, Trent. And I think that, and again, my opinion is I think we're in a perfect storm as an industry. We're definitely coming out of pandemic. Mortality still inconsistent with pricing, due to the factors I just talked about. In addition to the mortality issue, we're actually experiencing prolonged inflation, sharply rising costs around labor, around technology, transportation, medical benefits, a lot of other things. So both mortality and rising expenses are creating what is called in our industry slippage. Okay, and slippage is when you're not hitting your mortality number consistently, and when you're exceeding your expenses. And both of those components are actually in a product. Both those components are priced into your product. So um, when both of those components actually end up higher than expected, it puts pressure on companies' bottom line and profitability.
Hmm.
So if you were to look at term insurance, and term is not our primary market. We do some term, but companies do have a lot more term than we do. If you look at the term marketplace in an environment like this, when your mortality is higher than expected and the expenses to process and manage business have risen, and a lot of times those expenses are cost of labor, hiring people, it's an easy fix on term. Okay, you just go to a reprice. In a situation like this, you probably end up with a slightly higher price product, but it fixes the problem with term. And I think you're going to start seeing a lot more of that in the market happening as this economy continues to be where it's at. Um, but if you're seeing slippage in permanent blocks that have interest rate guarantees and have been reinsured, or there's been potentially table shaving in the marketplace involved, it can get much more complicated to fix. And fixes for these types of issues on permanent policies with slippage could be from selling underperforming blocks of business to reducing caps dramatically on in-force business, or trying to buy clients out of product designs that are unsustainable for the company. And I think we probably all have heard of some of those examples recently. Um, Other outcomes could be reinsurance companies that are experiencing slippage. They're looking for opportunities to work directly with large distribution groups. They may come in and offer to do underwriting instead of a direct company. Um, that will be profitable to them, but it could also eliminate for our agents underwriting competition, which I think is bad. Anytime you eliminate underwriting competition, it's really bad and can be restrictive. So that is kind of the kind of the landscape when it comes to slippage and expenses and mortality.
And now you mentioned a few of these things, like table shaving, but without naming names of carriers, are there any practices you're seeing going on currently that strike you as unsustainable or give you pause and concern?
Oh yeah. Oh yeah. And actually, when I think about it, I think of two that really jump off the page for me. And one is table shaving. It's always concerned me. I've been in the marketplace, for almost 39 years now. My whole career I've spent here, and I've seen everything. You can't shock me anymore, Trent. But um, when I think about companies that table shave, these are programs that can move insureds without credits to non-smokers if they're smokers, or can take away 2 or 4 tables right off the top of any type of risk. Um, you know, and I've heard lately why many companies, I've heard historically why many companies have tried it. You know, some you know, some companies feel that they can outgrow their mortality by adding a lot of new business to the books. Or companies are doing it to make up for the service constraints that their customers aren't getting. Um, or maybe other companies try to do it to buy into new types of business, or they're concentrated in old business and they want to move to something new. So they're really trying to move their sales that way. So, but no matter what the reason, it never works forever. These blocks of business are usually eventually called the impaired blocks of business that end up potentially getting sold.
Hmm.
I'll give you an example of an old company, and this goes back over 2 decades ago, maybe even almost 3 decades ago. There was a company, I believe, called U.S. Financial, and it shaved a lot of business and it made a lot of these types of decisions during good mortality times. And actually, the company ended up having to go find a white knight, and they found a white knight. It was a reinsurer, and they actually sold their company for pennies on the dollar. But
Wow.
then a few years later, that reinsurer also ran into trouble, and they ended up actually selling themselves for less pennies on the dollar. So obviously, having something where you're not pricing mortality and depending on economic situations can actually create a waterfall
Right.
where you just don't make up for that cost. So the moral that I always have of the story of table shaving is, look, pay now or pay later. Mortality at some point is going to make you pay, right?
Right.
Um, and if you're in a period of actual mortality slippage like we are today, coming off a pandemic, I actually think that's even more dangerous. So that's why I put that as unsustainable right now in our, in able to overcome some of those deltas between actual mortality and table shaving.
Hmm.
But the other thing that I don't think is sustainable, and actually it's one that concerns me a lot because I love this industry, Trent. Like I said, my dad was in this industry. I'm in this industry. I have a son and a daughter in this industry working for other companies. But um, when a company sells blocks of business to get out from under impaired or underperforming business, I think this hurts our brand as a company and can really hurt a policyholder and an agent's relationship with them.
Yeah.
Um, think about a client, trusting, you as an agent, right? And they trust you with their money. They have a financial plan based upon guarantees you illustrated. And then their policy gets transferred to another company because it was part of a block of business that gets sold. The buyer may not be even, actually the buyer may not even be an insurance company anymore. It may not, it may just be actually an investment. But usually a buyer can, and not all the time, but a lot of times they can actually reduce interest rates that are credited, caps on those policies to sometimes fund those transactions. But needless to say, it's a really hard conversation to go back to your clients and have and say, look, what I sold you a few years ago, that the illustration how it's going to perform, it's going to be different now.
Yeah.
Um, you know, and I want to come back to the mutual company uh, thing too, Trent.
Yeah.
Being a mutual company, that's not a strategy for us. You know, again, our focus is the policyholder. After the sale's made, we want them as long as we can have them. Um, blocks of business right now that I'm seeing being sold, they're not coming from mutual companies. So I think that's something for you and your listeners to take note of. Um, look, if I'm an agent today, um, make sure you as the agent or the agencies underwriting the companies that you're placing the business with. Sit down, ask those companies the hard questions before you place business with them. I personally believe eventually this is going to catch the ear of regulators and probably become harder for purchasing companies to mess with certain guarantees and things. But until that's done, I still think there's a risk, Trent.
Yeah. I mean, the last thing I would want is us to start looking like, the mortgage industry where your mortgage is sold every 2, 3 years, and then you don't know where it's at. Things get
Right.
lost, and no one ever has a good story about it. And you just do it
No,
because you have to.
no, but if you really believe, you're in a role as a steward, you
Hmm.
need to take care of your customers, and we definitely believe that in National Life. We
Yeah.
we not only take care of our policyholders, but we also want to take care of our agents too. We
Yeah.
want to make sure they don't have to go back and change the story to their clients.
Right.
So,
Well, let's end on a good note. What are some tailwinds you're seeing in the industry that are giving you hope?
oh, I see a lot. I am, I'm talking about some of the downside, but
Right.
let me give you the other side that I see almost every day. I think there's a lot of reasons to be optimistic. Um, I'm seeing young buyers looking at planning and buying IUL policies to protect them if they die too soon, if they live too long, or if they get ill and need help. Again, our average age is 37. Okay, that's pretty remarkable. I'm seeing these people in the middle markets realizing that they need something to protect themselves and their family. I think it's finally dawning on them that, you can't always count on Uncle Sam to be there. You're going to have to do something yourself. So I see a lot of optimism on that. I'm also seeing many more multicultural agents and women joining the sales ranks, which I think is fabulous. I think that opens up markets for us as an industry. You know, people are likely to buy from people that look like them. And I think if you have more of these segments in there, you're obviously going to be able to penetrate some of these underserved markets. I also see agents embracing technology. Some of these agents I'm seeing are younger themselves, and they're embracing technology just like their buyers. They're kind of aligning with all the cool instant issue and technology and things like that. So I think that's really a sign of optimism. And also the other thing that I like to talk about, Trent, is the evolution of the underwriter. Okay. Um, it's definitely happening here at National Life Group. Gone are the days of a back office decision maker that has no regards for the sales process, or you may never see or meet or anything like that. Tomorrow's underwriter is going to be able to tell you the markets you can easily sell into, can proactively tell you the medical and financial profiles of applicants that we're able to put on the books really quickly, understand the illustration and the markets the agent serves, and really become more of an asset to the agent. So I see a different orientation, and I think it's changed, but it's going to change even more. So I have those are a lot of reasons for my optimism.
Yeah. Well, I'll close with one last question that I think you're touching on there. Seeing as we end up having a lot of people listen to the end when it's a good dynamic conversation, and this is a good dynamic one, but uh we're coming up on an hour, so I want to close out with
Sure.
um niches that people should be considering National Life for. If they have a case pop up that looks like this, you just talked about underwriters giving you markets you can easily sell in. So, what would those niches that if a case comes up, they gotta be looking at National Life?
Well, I'm gonna definitely talk about the ones that we're writing on right now, Trent, if that's okay.
Please.
Um, a, a niche right now is middle market. We are a strong middle market player, and we do that with e-applications, technology, easy underwriting. Um, there's absolutely no pain there in that process. So that's definitely a growing and a really top niche for us. Also, large case underwriting and being able to provide a concierge service to large case underwriting. Any case over $5 million or 75,000 annual premium, you have a dedicated underwriter and a team that you can work with every day, and you can definitely on our new system be able to see the case and interact with that. And that's really become a very strong niche for us, especially these $100 million cases and foreign national cases I mentioned earlier. Emerging and affluent, emerging affluent and traditional premium financing. We have two different ones. We have the emerging affluent and traditional premium financing. It's always been a niche. I know there's headwinds in that space right now, but we are still seeing some that are coming in. So that's definitely a niche for us. We have an advanced sales team that can work with you and can help you, get those cases ready. I mentioned for a national underwriting program, it's with a nexus to the U.S., not citizenship based at all. Nexus is connection to the United States financially, home ownership, business, having a child as a student in the United States. Executive bonus for key employees is a niche. Multi-life, simplified or guaranteed issue, like a COLI type of a sale, is a niche for us. And that professional athlete program that we just talked about.
Yeah.
So there you
And
go.
there's one more to add that Lisa Azunian did for one of our sales shots, which we have another format where it's under 5 minutes sales shots for you agents. of the survivorship, which now becoming more concerned with the estate tax.
Yeah, that's an emerging one. Absolutely.
Yeah.
I think Trent, one of the things is these niches. We dream some of them up, but we also love to hear what your team is looking at. What's
Yeah.
the next thing coming? We love the feedback, interaction. What else should we be working on for niches?
Yeah.
So,
Well, she's got a great one coming out with that guaranteed income rider on a
yep,
survivor. That's
yep.
killer. I love that idea. So thank you, Bill. This was a great conversation and a lot of good information, and as always, the expected honesty with all this.
All right. Well, thanks for the time, and let us know what we can do for you.
Absolutely. And for those of you watching, Bill's our go-to guy. So we love placing cases with National Life. Follow, like, and subscribe for more of these. The more you participate, the more we can strong arm people like Bill to come on and talk to you and give you some background information. So we'll see you all next week. Thank you.